Happy September 6th. If you've been watching the news today, you know that the overnight interest rate was stayed by the Bank of Canada at 5%. You might be wondering, what the fuck does that mean? What does the key interest rate have to do with your life and real estate? What do fixed rate mortgages, variable rate mortgages, key interest rate, prime interest rate, overnight interest rate, and bonds all have in common? Well, watch this video and I'm going to explain it all for you. First off, let's talk about the overnight interest rate. The first thing to know is that the overnight interest rate and the key interest rate are the same thing. They are not the same as the prime interest rate. The Bank of Canada sets out the overnight interest rate. This is the same as the key interest rate. Currently, it's set at 5%. It's risen up since 2020 when it was set at 0.25%. Now, what is the prime interest rate? Well, banks are businesses. They want to make a profit. So we have your Bank of Montreal, your Scotiabank, your RBC, your TD. These are all companies out to make a profit. So they take the overnight interest rate, they add a little bit, and that is the prime interest rate that you are charged on all of your lending products. Now, what does this do with mortgages? Well, variable rate mortgages are based off the overnight interest rate. So if you had a mortgage in 2020, you could have got one as low as 0.99% on a variable rate. Today, you are sitting at about 6.8%. So if you purchased a mortgage in 2020, that was variable rate, and you still have it now, you could be paying almost double in your monthly expenses. That is why everyone is panicked. That is why they are freaking out. Why does the overnight interest rate get raised by the Bank of Canada? It is raised to combat inflation. If you have been paying attention to the news, you know that inflation has been out of control over the last 2 years. Last year, 2022, inflation was at 8.1%. This means on average, the cost of everything goes up by 8.1% per year. This is not sustainable. When the Bank of Canada raises the key interest rate, it makes the cost of borrowing money more expensive. This means that inflation is going to go down. It's going to go down because there's less demand on the economy. When the cost of borrowing money goes up, people spend less money. This puts less demand on the market, and this makes it more affordable, and those prices start to come down. Now, you can see why. Fuck her. Happy September 6th. If you've been paying attention to the news, you know today that the key interest rate in Canada was held at 5%. You might be wondering what that means. What is the key interest rate? What is the prime interest rate? What is the overnight interest rate? What do these things have to do with fixed and variable rate mortgages? What is the bind mark? Fuck. Happy Wednesday, September 6th. If you're paying attention to the news today, you've probably seen that the overnight interest rate was stayed by the Bank of Canada at 5%. You might be wondering what that means. What is the overnight interest rate? What is the prime interest rate? What is the key interest rate? What is the difference between a fixed and a variable rate mortgage? What is the bond market and what does it have to do with this? And how does inflation affect it all? Watch this video and I'm going to break it down for you real quick. So, the key interest rate is the same as the overnight interest rate. This is the interest rate set out by the Bank of Canada that all banks have to follow. The prime interest rate is the bank set out by the littler guys, your TDs, your RBCs, Scotiabank, BMO. Because they are businesses and they want to make a profit, they take that key interest rate, the overnight rate, and they add a little bit to it, giving us the prime interest rate. Why does the Bank of Canada raise the overnight interest rate? They raise it to combat inflation. If you've been paying attention over the last 2 years, inflation has been out of control. Last year, it was at 8.1% per year. This means that everything goes up at an average of 8.1% per year in cost. This is not sustainable. The goal of the Bank of Canada is to have an inflation rate of 2%. So when they raise the overnight interest rate, what it does is it makes borrowing money more expensive. This causes a slowdown in purchasing. When purchasing slows down, it slows down demand, slows down everything so that it balances the market a little bit more, bringing that inflation down by decreasing the demand. Now, what does this have to do with mortgages? Well, variable rate mortgages are based off the overnight interest rate. Banks need to make a profit. So they take the overnight interest rate and they add some to it, and that is the cost of a variable rate mortgage. So if you purchased a variable rate mortgage in 2020, the overnight interest rate was 0.25%. You could have got a variable rate mortgage for 0.99%. That is ridiculously low. That was never sustainable. Now today, with the overnight interest rate at 5%, you're getting a variable rate mortgage at 6.8%. So if you purchased in 2020, your monthly payments have probably just about doubled. This is why everybody is freaking out. Now, what is the bond market? Well, bonds are essentially an investment in Canada. The Bank of Canada issues bonds with something called a coupon. A coupon is an interest that they will give on that investment. These are not little purchases. These are billions of dollars in bonds. Other countries buy bonds, banks buy bonds. They are a safe, secure investment in Canada because they are guaranteed. So let's say, for example, you purchased a $1,000 bond with a 3% coupon. That means that at the end of the term, we'll say 5 years, that bond will be worth $1,000 plus 3%. Now, inflation is at 3.3% currently. So if a bond is issued at 3%, that's not a good investment. Nobody wants that. You are going to lose money every year because every year that money that you purchase that bond with becomes less valuable because inflation takes away its purchasing power. So what happens? The bond is traded in the bond market. So if I have a $1,000 bond and I have a 3% coupon and inflation is 3.3%, no one's going to buy it for $1,000. So all of a sudden, I'm going to have to sell that bond for $900 in the market. And now that interest, that yield that they are going to make on the bond that I just sold them is going to be the difference between $900 and $1,000 plus 3%. So they're getting a better return on that bond if they purchase it from me for $900. Now, that percentage between the $900 and the original price with coupon of that bond is called the yield. That yield needs to be lower than a fixed rate mortgage. So when bonds go down in price, fixed rate mortgages go up in price because mortgages are also a large investment for banks and countries, but they are riskier than bonds. So they need to have a better return. So if the return on your bond is 4%, then that means a fixed rate mortgage needs to give a better return. It needs to give 5% or 6%. Typically, they give 1 to 3% more just to make up for that little bit of risk. So, what causes bonds to go up and down in price? Inflation. Inflation determines the price of bonds. Inflation determines the overnight interest rate. Inflation determines what your mortgage is going to cost, fixed or variable. By knowing to check the bond market, what inflation is, how it's been moving historically, what the overnight interest rate is, and just understanding these 3 simple things will help you make an educated decision when it comes time to purchase a mortgage. By working with a team of real estate professionals, having a mortgage broker, having a realtor, you know that you are going to be in good hands. So you can follow along, click below, like the video, tell me what you think. This is a very basic video, a very surface look at the market, but I hope that it helped you understand a few key terms in understanding mortgages, interest rates, and how they work in Canada.